In the last week of January 2026, something just snapped. A critical gear in the global financial machine that had been turning for decades suddenly broke. We're talking about the silver market. And this is the story of how the entire world discovered that the price you see on the screen, well, it might just be a work of fiction.
It all started with a number. This number. On January 29th, if you were on the streets of Delhi or Mumbai, this is what you were paying for 1 single kilogram of silver. That's over 12,000 US dollars. But get this, the official price back on Wall Street, it wasn't even in the same universe. Right away, you knew something was very, very wrong.
And this wasn't just some glitch on a trader's screen. No. On the ground, in the physical markets in China, you could feel the panic. People were literally lining up, paying these huge premiums, absolutely convinced that whatever they paid today, the price was going to be even higher tomorrow. This was a human reaction, a real panic, not some trading algorithm gone haywire.
So that brings us to the big question, right? The one we're here to figure out. What on earth was happening to the price of silver? I mean, how does a global market that seemed totally stable just fracture into pieces almost overnight?
All right, so to really get how we got here, we're going to break this story down into 6 key parts. We'll start with this idea of 2 completely different silver markets. Then we'll look at the frantic run on the vaults, a totally shocking geopolitical power play, the market's emergency kill switch, what's being called the Great Divorce, and finally, what silver's new strategic role means for, well, all of us.
Okay, let's dive into the first piece of this puzzle. You really have to get your head around this. There isn't just one silver market. There are 2. And for years, they've been in this quiet, unspoken war with each other. So on one side, you've got the paper market, centered in New York and London. Let's just call it the casino. This is where they trade futures, contracts, basically a mountain of IOUs for silver that may or may not exist. It's totally dominated by the big banks. And then, on the other side, you have the physical market. Think Shanghai, Delhi, Dubai. Let's call them the landlords. They don't mess with paper. They deal in actual, heavy, 1,000-ounce bars of real metal. Their world is driven by real industry and real countries needing real silver.
And for years, the cracks between these 2 worlds were getting bigger and bigger. The clearest sign was something called the Shanghai Gold Exchange Premium. Put simply, buyers in China were always, consistently paying more for a real bar of silver than the official paper price set in London. It was this blinking red light, a signal that the physical market was already straining under massive demand, way before the whole thing finally snapped. So all that strain, all that pressure, it led directly to our second chapter, the Great Physical Squeeze. This is the part of the story where the landlords basically decided they were done with the casino's paper promises and started saying, "Show me the metal." And well, here's the dirty little secret of the paper market. At its worst, for every single ounce of actual physical silver sitting in a registered vault ready for delivery, there were as many as 356 paper claims, all these IOUs trading against it. Let that sink in. The entire system was built on one incredibly fragile bet that almost nobody would ever show up and ask for the real thing.
But starting around 2020, they did. Big time. Investors, entire industries, even sovereign nations started pulling physical silver out of those Western vaults at an incredible rate. By the time we get to January 2026, the amount of registered silver just sitting there available for delivery at the COMEX exchange in New York had plunged by over 70%. The drain was on.
And this is where that slow drain turned into an absolute avalanche. In just the first 3 weeks of January 2026, over a quarter of what little was left in registered inventory, gone, pulled out. The average daily withdrawal rate just about quadrupled. This wasn't a slow leak anymore. It was a full-blown bank run on the vaults.
And this had devastating real-world consequences. I mean, look at this. In Rajkot, India, a huge hub for silver trading, 44 firms went belly up. Just gone. Why? Because they were playing the paper game, making bets on the casino's price. When the volatility went crazy and the house changed the rules, they got wiped out. They were holding paper promises, not physical bars.
So you've got the vaults draining, traders going bust. The whole market was basically a tinderbox just waiting for a match. And that match came from a place nobody, and I mean nobody, saw coming. A geopolitical bombshell over Greenland. It all happened so fast it was dizzying.
January 17th. The U.S., in this wild move to pressure Denmark over Greenland, slaps a tariff on 8 EU nations. The very next day, U.S. Customs causes total chaos, misclassifying bullion bars and grinding shipments to a halt. By the 20th, the EU is threatening a massive trade war. And the timing? It could not have been worse. This was all happening right when the London market was desperate for physical silver from New York. That crucial arbitrage trade, flying millions of ounces of silver across the Atlantic to keep the market balanced, was suddenly paralyzed. The metal was literally grounded.
So now, with the physical supply chain broken and the paper price just rocketing upwards, the casino was staring down catastrophic losses. So, what do? What any house on a losing streak does. They changed the rules of the game. They reached over and flipped the kill switch.
So how does this so-called kill switch even work? Well, the referee here is the CME Group, which owns the COMEX exchange. Problem is, its main members, the big banks, were on the hook for billions as the price went vertical. So the CME flips the switch. They suddenly jack up the margin, which is just the cash deposit you need to hold a silver contract. This move instantly forces all the smaller players, the very people betting on higher prices, to sell. They simply can't afford the new, much higher price of admission.
You gotta love how macro strategist Jen Bodden put it. She said the CME's official line about a 47% margin hike was just bank speak for "we're changing the rules because we're losing." It had nothing to do with managing risk, it was about protecting the house by kicking out all the winning players.
But here's the crazy part. The kill switch totally backfired. Sure, it caused a temporary crash in the paper price, but the physical buyers? They just saw it as a massive fire sale and bought even more. The damage was done. All trust was shattered. And this led to the final, irreversible outcome, the Great Divorce.
Market analysts everywhere are now calling it the Great Divorce. And what it describes is that moment, that week, when the paper price quoted in New York and the real-world price of a physical bar in Shanghai just went their separate ways, for good. The link between the promise and the actual metal was permanently severed.
And this right here shows the new reality perfectly. While the paper price on the COMEX might say $83 an ounce, if you actually wanted to buy a real bar in Shanghai, you were paying $91, maybe more. The Western exchanges had lost their power. They no longer set the global price. The landlords were in charge now.
So you have to ask, why did this happen now? After all these decades, why did this system finally break? Well, it's because the world suddenly woke up to silver's new reality. It's not just a precious metal anymore. It's a critical, absolutely strategic asset.
And this is maybe the most important takeaway of all. Right in the middle of all this chaos, the U.S. government officially designated silver a national security issue. That changed everything. Suddenly, this wasn't just about money or markets anymore. It was about nations scrambling to secure the physical supply of a metal they needed to build their future.
And this chart shows you exactly why. Just look at where the real physical demand is coming from. 35% is for solar panels, over 20% for AI data centers and the new nuclear reactors we need to power them. Another 19% for electric vehicles and electronics. These aren't optional things. They are the non-negotiable, foundational pillars of the 21st century. And nations finally realized they couldn't risk their entire future on a paper promise from a casino in New York. They needed the real stuff, the physical metal, in their own vaults.
Which leaves us with one last, kinda unsettling question. The events of that week didn't just break the silver market, they broke a fundamental trust in how we price, well, everything. It was a brutal reminder that the price on a screen and the value of a real thing in your hand can be two totally different things. So the question we're all left with is this. In a broken market, what is anything really worth?